Hello and welcome back. If you're watching this video, you are in for a treat. I'm going to be giving this one away, this spreadsheet that you're looking at over here. And you can basically use this to calculate a DCF model, a quick and simple DCF model that's pretty effective though, for any stock that you want. And you can find a link in the description box below for this spreadsheet. And the only thing that I ask for in return is that you like this video and subscribe to the channel, because there's going to be a lot more happening here. And for now you're getting this dog, but later you're gonna be getting a lot more, because I am preparing software that will be automatically doing all this for you, and you can just very quickly analyze a stock and discover how much you should be paying it for it today. Now let me tell you how this works and how we're gonna be using it here. And in this example, I'm gonna be using it with Alibaba, a stock that is a very nice potential buy over here at its current price. And I think it's a nice candidate for examining how much we are willing to pay today in order to make some money into the future. The way we're going to do this is we're going to use a discounted free cash flow model. And I have made videos about it in the past. Again, I will add links to the description box below, so you can take a look later after you're done with this video. But what we are aiming to do here is using historical data of Alibaba's free cash flow generation, we will project the free cash flow into the future 10 years from now and discover how much we are willing to pay today to buy stock in Alibaba if we want to be making a 10% gain on it or a 15% gain a year from our Alibaba shares. This is what we're answering to here. Now, how do we do that? You will see here, and this is all formula calculated. I mean, it's calculated with formulas. You can basically just substitute some of the values and it's gonna be automatically changing the values for you in the doc. Nothing is static. Now here, what we are doing, we are examining the free cash flow of 2017 to 2021. And you see these columns have different colors here to denote that they are actually present values, because we know of this. This is data that we know of. It's the free cash flow in millions that the company is making in 2017 to 2021. This is known data. And the free cash flow growth for, year over year. Of course, the first one doesn't have a free cash flow growth because that's our starting year. We could have used 2016, but I'm just calculating this 5 years with the data that we have here. I just want to keep it to 5 years. I think it's convenient. And so you will see, for example, this one is a formula. It's basically calculating the free cash flow growth from year 2017 to 2018. Same with this one, calculating from 2018 to 2019. There was a 1.7% growth in free cash flow in this year. And this value here is the 5-year average free cash flow that we know of, the 5-year average here, which is almost $19 billion. And the 5-year average free cash flow growth is another formula that's basically the average of these free cash flows here, the growth average, which is about 31.08% over here. So what we're doing next, and this is automatically calculated by the doc, the spreadsheet here, and you can see the values here and the formulas, and again you will gain access to all of these. So what this does is it's projecting values into the future, into 2022, 2023 till 2030 over here. It's projecting these values into the future if the company is enjoying a 31.08 free cash flow growth per year, which is the average. Now we could obviously change this value, and again it will be reflected here, but I'm just using the average of these 5 years over here, specifically these 4 basically, just to get a percentage that makes some sense, because the average free cash flow growth of the company has been around this level over here. You can be more conservative and bring it down more, or be less conservative and bring it up. But I think it's a fair calculation, and this is how we typically go about making some potential projections. You could do all sorts of different projections in your sake and play with these numbers. Again, these are all formulas here. So the total 10-year, upcoming 10-year free cash flow that we're gonna be gaining if we buy stock today This is 2022, but it's considered almost 2021 yet. I mean, it's basically the growth starts from here. That's what we're saying, from this year. If we actually add all these free cash flows together, we're getting a total 10-year free cash flow of $1.2 trillion here. And that's what the company is going to make in free cash flow. Now, we want to be using, again, a free cash flow model, a discounted cash flow model here, because $1.2 trillion in these 10 years and in 2030 is not the same as if we had $1.2 trillion today. So this has to be discounted back into the present value of today. Plus, we also want to be making some money in the meantime, right? So we want to be making money while the company is generating its own money every year. And so what we're going to do is we're going to use a discount rate of 15% is what I'm using here. Again, it's all added into a formula and we can play with it, and we will a little bit later in the video. But what we are effectively saying here is we want to be getting a 15% gain for our sake every year from our investment in Alibaba. And if we do get this 15% discount rate, what should we be buying the stock for today if we discount at this rate and bring it back to 2022 right now? And so this is a formula that I have also added here, the how to discount formula, and tells you how much the present value of a future value is. So what is the present value of 1.2 trillion over here is what we're calculating. And this formula is added here, as you can see, is this formula, and it calculates that this is $315 billion over here. Now, we do have an outstanding shares count over here in million, and that's the, as you can see, it's 2.71 billion multiplied by 1,000 to make it millions. And this is the outstanding shares of the company. 2.71 billion is the outstanding shares of Alibaba in this case. So if you are calculating your own company, you need to change this one to make it to reflect the company that you are calculating for. And so if we do this calculation here, which calculation? The calculation is the present value of the 10-year free cash flow. It's basically what we are getting in 10 years if we discount it for today. That's what it is. So we're calculating it today. And we divide that with the amount of shares. We get how much we're willing to pay today per share of Alibaba in order to enjoy this 15% gain every year. And again, this is all if accounting goes into plan, of course. I mean, you never really know what the sentiment of the company will be. People will maybe paying more, maybe paying less. After all, it's a market. But if we are strictly calculating the company making 31% increase of free cash flow every year for the next 10 years, and we discount that to 15% a year, really, and go back to today and see how much we're going to be making in present value, then per share, we want to be paying $116 today in order to enjoy this appreciation of 15% of our money. And so this effectively means that according to this model, and if things are actually followed from here, from 2022 till 2030, and something like this happens, a scenario of that sort happens, it means that if we invested $10,000 today, we're going to be getting a 15% interest a year. And if you calculate the compound interest, because this gets compounded every year, we're getting, again, this is a formula here, this formula, the compound interest formula, we're going to be getting $40,455 in 10 years. So we're going to effectively quadruple our savings, our investment here of $1,000. And again, you'll see this is a formula here. I mean, if I change this value and I make it, let's say that we invest $50,000 instead. Now we're going to be making $202,000. Now let me take it back to 10,000 and let's just play and make some different scenarios. Let's just say that I want to be making a little bit less from Alibaba. Typically, you make like a 10% gain on an ETF per year in the stock market. So if you get the S&P 500 ETF, which tracks the stock market index, that's the S&P 500, you typically get about 10% a year for the last century or so. So when you're investing into a single stock, you have a little bit more of a risk. So let's say we want to get a 13% instead of 15. and we're fine with that. There is a small problem here. What happened? Let me find it. Okay, so phew, that was weird. Some sort of issue with copy pasting, I guess. So if we discount it at 13% over here, now the price that we are willing to pay per share is $138.8 today. And if we want to be making 20% a year on our money, then we are willing to pay 76% today. So we're much more conservative here. Typically, I want to be at around 13 to 15%. So 15 is fair with Alibaba because that's the about price of it right now. I think it's a little bit more. Today is 120, so this would be probably about 14%. That would make more sense here. Yeah, I think this is the about price of Alibaba today. I think it's a little bit less actually. But this gives you an idea of when you are setting a specific discount rate here, how much you're going to be making into the future again, if you are willing to buy Alibaba today for 127. And of course, the other thing that matters when we are doing these calculations is the Alibaba's outstanding shares, because that's the free cash flow per share really that you are making in all these years. So if Alibaba actually buys back shares, which they have announced that they will, you may at some point see Alibaba having 2.5 in terms of outstanding shares over here. And that again affects the price per share, for example. And so this is something to pay attention to, and you will see that it affects the price per share to pay here, because the less shares that are available, the better it is for you, the more money you're going to be making, because there is each share that you own is worth more if there are less of those. So hopefully that gives you a very quick and nice mechanism to quantify how much you are willing to pay for a company. And again, this model can be adapted to all sorts of ways really. In the software that I'm making, I will actually allow for people to set these values explicitly, so you could be able to set 10 here, 15 here, 20 here, and then do the calculation without having to rely on an average here. You can do all sorts of projections this way, because this obviously really affects the outcome for the 10-year calculation here. Plus, I'm going to allow people to do it for more than 30 years or less than 30 years. So it's going to be much more easy to adjust values there and compute different scenarios. But this, for now, I think it's a very interesting way to just quickly evaluate a company. And you can just change a couple values here, like the outstanding shares is what you would need to change, for example, here. And also the free cash flow that the company is making is pretty much the values that you need to change in order to calculate the DCF model for a different company. And that's all that you need to do. Everything else will be calculated automatically for you. And hope that that helps you. I try to make this doc to help investors that want to quickly calculate a simple DCF model, because it can get very complex if you add all sorts of different metrics and values, like the WACC, for instance. But I didn't want to take it that far, because I want to have a very simple mechanism and a simple way for investors just to quickly evaluate without having to learn everything about investing and accounting, really. And hopefully this helps you. And if it does, again, please leave a like and subscribe. That really helps a lot and helps the channel grow and allows me to make more videos and then help you back in return. And so again, if you like this video, you may want to find the link in the description box below that takes you to this doc, and you can download it and or copy it on your account and make all sorts of calculations for your own stocks. And thanks for watching. I thank you a lot for being around and for liking the videos and leaving comments. Let me know if there was something that you'd like me to adjust or add to this one by leaving a comment below. And also let me know what other type of video you'd like me to make into the future. And again, thank you for watching. And if you enjoyed this one, hope I'll see you soon. Thank you. Bye-bye.